Hello everyone, and welcome to our market alert video for today, the first day of August 2025. Man, this year is flying by, and we're off to a pretty lousy start to August. So we're going to get into the jobs numbers, which came in really bad. And what does that mean? What are the repercussions of that? Does it mean we're headed for recessions or bad times or not? We're going to go over all of that from our point of view. And as always, well, let me introduce myself first. I'm Ken Moraif, and I'm the founder and CEO of Retirement Planners of America. And so, as the name implies, we specialize in retirement planning, so we look at people who are within 5 years of retirement or who are in the first 5 years of their retirement. So if you're in that decade, then this video, all of our podcasts, everything is designed for you. So our perspective in terms of the jobs and what they mean is going to be from that lens, right? We want to talk about those of you who fit in that category. What does that mean to you? And so we're going to go over all that with you. Before we do, though, I just want to thank you for watching. We now have had over 1 million views of our podcasts and our market alert videos, and that's you. So thank you so much. That's just blows my mind. It's so flattering. So let's get going. Let me bring Jordan Roach, our Chief Investment Officer, into the conversation. So Jordan, good to see you.
Good to see you during a lousy month.
Man. Yeah, lousy month. One day, right?
One day, always. Historically, my least favorite, and maybe the market's least favorite as well.
I think that's true, isn't it? Like historically, August and September are like the first and second worst months of the year almost every year.
That's right. Heat sets in here in Texas, the market starts going down.
Well, we start off with some really bad jobs numbers and like eye-popping, right? So the revisions for the last 2 months, we're down 258,000 jobs. You know, I start to wonder who's like doing the math over there. Remember last year when they missed by 1 million jobs?
Oh, yeah.
1 million. Now, 258,000.
Seems impossible.
How could you be that far off?
It's wild. You almost, you look at a data print, you need to wait a month or two because you know it's not the right number.
Yeah, I mean, it's remarkable to me how much they've changed it.
Yes.
And so that's the big headline. Right, and so the stock market obviously did not like that at all. What's your take on the stock market? Why are they selling off in this news?
Well, I think there's a few reasons. I mean, again, I think that it's always been a push and pull this year of the fears of finally the economy is going to be weak and we're going to slow down and have this recession. And the other thing is going to be that any sort of tariff fueled sell-off, right? Of tariff spike. So those two things. And so this is maybe the first.
So it's tickling that nerve. People are like really nervous. And it's like, aha, there it is.
We've been waiting for inflation to spike. And now maybe we had the first time that actually the economy is like, uh-oh, what are we doing here?
Yeah. So let's open the hood or look under the hood, peel back the onion, pick your cliche. All right. So first of all, as we look at what happened, it looks like primarily the jobs were in government workers and foreign-born workers. So those were the reductions, the vast majority of those reductions.
See, and that's where it's important. You see a number, and then you want to look inside and say, okay, which part of this equation was it leading? And seeing, government jobs both at the federal and local level coming back down, seeing foreign-born jobs, I don't know how much the market really is surprised, despite selling off a little
that's
today.
What Donald Trump is doing, right? With DOGE, there's a lot of government workers are being laid off, and then of course, with the deportations and all that, so we're seeing the foreign-born workers as well.
Yes, and I think maybe even we'll see more of that coming, right? Because we've even seen the full extent of all those cuts come through on the public sector.
Yeah, a lot of people right now are on severance, and they're not counted as unemployed until they come off that. So we're going to see more government workers. So, one of the things that I think a lot of people are not aware of is how do you calculate the unemployment rate?
Right.
And basically, the denominator is a labor force, and that's shrinking, right? Because we're seeing government employees and foreign-born people, leave the labor force. So if the denominator is shrinking, then you look at the denominator, which is the people who are employed that are being laid off.
Yes.
And we're not seeing a lot of layoffs. People are holding on to their employees. They love their employees. They've trained them. They've got them in there. They don't want to let them go. So if the denominator is staying the same, but the denominator is getting smaller, then you're going to get a bigger number. So the unemployment rate is going to go up.
That's right. I mean, and I think that's what we're seeing is we're just seeing, the people in the labor force, the amount of job openings is just contracting a bit. We're not necessarily seeing a bunch of layoffs. It's because we saw unemployment just tick up barely. It's still in the low fours. right? So we're not seeing this huge spike. We're still very much in sustainable long-term numbers there.
So from a stock market standpoint, our view then is this is probably more like a profit-taking thing than it is a forecaster of recession and horrible economic events.
I think probably so. Now, again, the market wants to front run all this, so it's going to look out and say, okay, could this be the start of a trend, right, of contraction and weakness? So you don't know how long the market's going to have to sell off before it finds a settle point, but I do think this is most likely profit-taking coming in. We got a month end. August is weak, so that's probably what it is.
So the nervous Nellies who are thinking, tariffs are going to kick in, unemployment's going to kick in, inflation's going to kick in. The nervous Nellies that have been thinking that's going to happen, this tickled that nerve. And
all-time highs, basically book profits.
Okay.
That's it.
All right. So let's look at the other side then. Let's look at bonds, right? So right now, bonds are maybe the best game in town, right? Because
at least for the day,
with these numbers, the Federal Reserve now, the market's pricing in a 70% or better chance now of 2 rate cuts, when like yesterday it was like maybe 1 and it was only like a 40% chance. So it went from 40% chance of maybe 1 to a 70% chance of 2 with one number print.
That's right. I mean, typically there's a couple scenarios where you see bonds historically do pretty well. It's where if they see economic weakness and then therefore the Fed going to pull rates down, typically bonds rally, at least Treasury bonds. And so we're seeing that today, is bonds are rallying while market is selling off.
So because there's that inverse relationship, which we've talked about on previous videos, the bonds values tend to go up when the Fed lowers interest rates and vice versa. So if the Fed's going to lower interest rates 2 times this year, bonds are going to go up in that environment. And so from a bond perspective, that's a good thing.
Yes.
Yeah. Now, the other thing also that if the Fed starts to lower interest rates that could be very well affected, it could be a positive, is the real estate sector, which is 20% of our economy.
Yes.
And it's been relatively like stuck in the mud with these high interest rates, right? I mean, it's basically nothing's happening there. The Fed starts lowering interest rates, to any significant degree, that could unleash, a lot of movement and a lot of construction and all that, which could, a lot of jobs, a lot of economic activity.
A huge part of overall our economy, right? Because you have construction companies and housing builders that are going to employ a lot of people. You're going to see people have access to capital. If the rates come down, then they're going to be spurred because their borrowing costs, as cost of capital goes down. And then that could unlock homeowners, start buying again, can free up cash flow if they can refinance. And there's a cascading, events there that would be positive.
Yeah.
So I think that's the one, economic data point I think broadly that has been stuck in the mud for so long that maybe people would normally say it's a harbinger of bad things, but maybe we're getting to a tipping point.
Yeah. So overall, our outlook is still positive for the second half of this year. Stock market should still do well, even though right now it's behaving, the way it is. Bond market may suddenly find its footing, as you like to say, and pick up strongly in the second half of this year. However, having said all of that, and I just want to say one of the things that I've started doing is looking at the comments section, on our
dangerous.
YouTube.
It's always dangerous.
And it's interesting that people have comments, which is great. And somebody said, Ken, in all your market alert videos, you always say, things are looking fine right now, but then you talk out of the other side of your mouth and you say, but it could go bad, and well, yeah.
Because that's how that works. That's exactly right.
I'm not talking out of both sides of my mouth.
No.
I'm telling you the truth. Yes, right now, we don't think that, this data point is the next recession and the next big bad bear. In fact, we think that, the stock market is reacting normally. The bond market is reacting normally. And we should be okay. Consumer's still okay. Unemployment's okay. Inflation. So the things that we look at seem to be okay still. But that doesn't mean that's going to last forever, and you should always prepare for the worst if you are in that decade we were talking about.
Yes, I think planning that this is going to go up in perpetuity and it's always good is not good. I mean, you could be driving in a car and skies are clear and nothing's in front of you, and that can change very quickly.
Oh boy, can it? Especially in Texas.
That's right.
Wait 5 minutes if you don't want if you don't like this.
The
weather.
market has way too many things to consider where it could not change in an instant. Right, and that's always what we're talking about.
Yeah, and the thing also, and the thing that causes the market to go way, way down is the thing that nobody sees coming.
That's right.
You know, I'm a boxing fan, and my wife once told me that if she had known that, she never would have married me because she thinks boxing is, you know, brutal and barbaric.
Yeah, sure.
And, you know, she's embarrassed that I even say that I watch boxing. But the thing about boxing is you could have two guys that are wailing on each other. I mean, for 16 rounds, they're just beating each other up, and nobody gets knocked out because they see the punch coming every time, and they brace for it. And then you see, like, the punch that comes out of nowhere, and the guy's knocked out. And that's the same thing with the market. The thing that the market anticipates that they see coming is rarely what causes the big bad bears.
That's right.
It's the, whoa, what happened? You know, it's like the credit crisis when, oh my gosh, the entire credit system is frozen up and we're going to see, you know, banks start collapsing. Nobody saw that coming and boom, the market went way down. So it's the surprise. So yes, we think things are great, but we must always be prepared for that bad thing. And I'm not talking out of both sides of my mouth. I'm just being prudent. You know, we have responsibility with our clients. We want to make sure that their money lasts as long as they do. And we can't just say, well, everything's rosy and we're not going to plan for anything bad happening. You know, we got to plan for the bad stuff happening and then hope the good stuff happens. That's the better way, I think.
I mean, we'd love to never have to plan for the bad, for sell-offs. Right, we wouldn't have to be doing this if that was always the way it worked.
If it was always going to be good, right?
That's right.
So for now, we think it's good. So speaking of comments, I just want to thank everybody. As I said at the top of this video, we crossed over the 1 million views mark, and man, that's just insane to me. So thank you guys for doing that. We have a fantastic podcast for you that you should watch on the 4 stages of your financial life cycle. And I think, Jeremy, you've attached it to this. All right, cool. So make sure you watch that. Make sure you watch our podcast on tariffs because it's been uncannily correct, perhaps the best podcast ever produced.
Smithsonian worthy.
The Smithsonian is going to put it in their library so future generations can see this podcast because in the annals of podcasting, I think there's nothing ever been done that's better, and it's thanks to you. You just did a great job. But I was looking at the comments section, and you know, I'm there and I'm thinking, you know, people are going to be saying, Ken, Jordan, you guys are so insightful. You're so all over the economic stuff.
Of course
you know,
not,
you are fantastic at helping us with our investments and all that good stuff. But no.
What are they doing?
One person said, you know, that it was all about my attire.
Oh.
Like they don't like the button-down shirt.
Oh, no.
They want me to wear a shirt like yours with no button. I've been wearing a button-down shirt for like my entire life. I have like 12 of these, and I bought them for like $40. You know, I'm not going to buy, what is that, a $95 shirt?
Sure, yeah.
Yeah,
that's
right? So
yeah.
I'm not going to pay $95 for a non-button-down shirt.
Fair.
And then, you know, then they're like, you should be wearing a Submariner. It will look good on you.
You would look good with that.
Well, you
I
know,
agree.
that is a true statement, but there's somebody else involved in this whole equation, and that's my wife. There is no way my wife is going to let me wear a $27,000 watch. So thank you for the comment, but it ain't happening. And then somebody else said,
work on it.
And then somebody else said what they really like about my Apple Watch is they can see what time it is that we're recording the show.
Oh, wow.
So no, I'm going to block it so you can't see it anymore, okay? Sorry.
They did a freeze frame on you, and we're trying to figure out, are we being truthful when we're
That is an
recording?
attention to detail.
That's
that guy
incredible.
should be a CIS and you know, investigate the murder
That's pretty
scenes.
good.
So
Pretty
yeah,
good.
so I don't know. I'm sorry. I'm not getting the Submariner. I'm not changing my watch. I'm not gonna. No.
Okay,
no.
well, I'll help out there.
The only
on
thing
some
I
of
might
those
do
things.
is I'm getting worried about the gray. I may do something. So if I show up with really dark hair one time, you'll know what that was all about. So anyway,
just do it all at once.
so I just
do it.
Just
Go
get it
darker
over with.
hair.
go dark.
Open with the Submariner.
Man, I'll be a new,
yeah.
completely different
Yeah.
person, and then we'll have 2 million views, or maybe 2. Anyway, thank you guys for watching. I appreciate your loyalty and your, you know, that you've put us where we are. Make sure you like and subscribe. Watch the 2 podcasts that I just told you. I think you'll love them. And certainly visit with us if you're in that retirement mode. We'd love to help you if we can. So again, thanks for watching. Hope it found you healthy, wealthy, and wise. And we'll talk soon.
Retirement Planners of America, RPOA.com.